What if the biggest financial shock of your lifetime is already in motion, quietly, slowly, and right in front of you? Not with sirens, not with breaking news banners, but hidden inside numbers most people never look at. For decades, the US dollar has been the backbone of the global economy. It survived wars, recessions, oil shocks, political chaos, and even its own mistakes. But now, in 2026, a serious question is being asked by investors, economists, and governments around the world. Is the dollar facing a real collapse, or is this just another fear cycle? Today, we're cutting through the noise. No hype, no clickbait. Just history, data, and reality. Before we go any further, if you care about understanding money, power, and where the global economy is really headed, make sure you like this video and subscribe to Empire Economics. This channel focuses on facts, long-term thinking, and signals most people miss. Subscribing helps you stay ahead instead of reacting too late. Now let's slow down and get grounded, because the idea of a dollar collapse gets thrown around a lot, and most of the time it means nothing. A true collapse isn't when the market dips or inflation runs hot for a year or two. A real collapse is when trust breaks, when people, institutions, and countries stop believing that the dollar will hold its value tomorrow the way it did yesterday. And trust, once lost, is incredibly hard to rebuild. To understand whether 2026 is different, we need to zoom out. The US dollar didn't become dominant because it was perfect. It became dominant because, after World War II, the United States was the strongest industrial power on Earth. Its factories were intact, its military unmatched, and its economy massive. And the Bretton Woods system locked the dollar to gold, and other currencies were locked to the dollar. Even after the gold standard ended in 1971, the dollar remained central because global trade, oil pricing, and financial markets were already built around it. But dominance has a cost. When your currency is the world's reserve, you have to supply it to the world. That means deficits, it means debt, and it means other countries holding your promises instead of gold. For decades, this system worked because the US economy kept growing, productivity expanded, and global confidence stayed high. Here's where the data starts to matter. US federal debt crossed $1 trillion in the early 1980s. It took more than 200 years to get there. Today, that number is over $34 trillion. In just the last few years, trillions were added in record time. This isn't politics. This isn't opinion. It's math. And the speed of debt growth is just as important as the size. At the same time, interest rates are no longer near zero. For over a decade after the 2008 crisis, the system survived because borrowing was cheap. When rates rise, debt becomes heavier. Every percentage point increase means hundreds of billions more in interest payments. That money doesn't build roads, improve schools, or increase productivity. It just services old obligations. Inflation added another layer. When inflation surged after 2020, many people assumed it was temporary. Supply chains, stimulus, pandemics, reasonable explanations. But inflation did something deeper. It reminded people that cash loses value. It reminded savers that safety is not guaranteed. And once that psychological shift happens, behavior changes. Now, let's talk about global signals, because the dollar doesn't exist in a vacuum. Countries like China, Russia, and others have been reducing their reliance on the dollar for years. Not overnight, not dramatically, slowly. Bilateral trade agreements in local currencies, central banks increasing gold reserves, alternative payment systems. None of this means the dollar is about to vanish, but it does mean the world is hedging. History shows us that reserve currencies don't die suddenly. They fade. The British pound didn't collapse in a single year. It lost influence over decades as the British Empire declined and debt piled up after 2 world wars. The pound still exists today, but it no longer runs the world. The same pattern matters more than the timeline. So why is 2026 even part of this conversation? Because multiple pressure points are converging: high debt, higher interest rates, political polarization, aging demographics, rising defense spending, and a global system that is no longer unipolar. When stress builds across multiple fronts, systems become fragile, even if they look strong on the surface. But here's the part. Most hype videos won't tell you. A dollar collapse does not automatically mean chaos in the streets or instant hyperinflation. The United States still has enormous strengths: deep capital markets, legal infrastructure, military power, innovation. The dollar is still used in the majority of global transactions. There is no clean replacement waiting in the wings. That's why the real question isn't, will the dollar collapse in 2026? The real question is, what kind of dollar are we moving into? A strong but slowly weakening dollar is very different from a sudden loss of confidence. One is manageable, the other is dangerous. Financial markets are already sending mixed signals. On one hand, the dollar remains strong relative to many currencies. On the other hand, gold keeps making new highs. Central banks are buying gold at levels not seen in decades. That tells you something important. Institutions with long time horizons are preparing for uncertainty, not certainty. For everyday people, this matters more than most realize. Wages, savings, housing, and retirement are all tied to currency stability. You don't need a crash to feel pain. You just need slow erosion. 5% inflation over several years quietly reshapes your life without a single headline screaming, collapse. This is where empire economics takes a different approach. Instead of asking what will happen tomorrow, and we ask what trends are already in motion. Debt doesn't reverse overnight. Trust doesn't disappear instantly. But both can reach tipping points when ignored long enough. As we move deeper into this video, we're going to break down the hard data behind dollar strength, the myths around de-dollarization, and the realistic scenarios for 2026 and beyond. Not fantasy, not fear, just probabilities. Because the truth is, the most dangerous financial moments are the ones that feel normal right up until they don't. And this is only the beginning. If we really want to understand whether the dollar is heading toward collapse or simply transformation, we need to separate loud narratives from quiet facts. One of the loudest narratives right now is de-dollarization. It sounds dramatic, and that's exactly why it spread so fast. But the reality is more subtle and, honestly, more interesting. Yes, some countries are trading outside the dollar. Yes, central banks are buying gold. Yes, there's frustration with U.S. financial power. But here's the part most people miss. Over 85% of global foreign exchange transactions still involve the U.S. dollar. Most international debt is still issued in dollars. Commodities, especially oil, are still largely priced in dollars. This isn't a system that disappears because a few agreements make headlines. Think of it like this. The dollar is not dominant because everyone loves it. It's dominant because it's liquid, trusted, and deeply embedded. Replacing it would require an alternative that is just as stable, just as open, and just as scalable. Right now, no currency checks all those boxes. The euro has size, but it lacks political unity. The yuan has ambition, but it lacks trust and free capital movement. Gold has history, but it lacks flexibility. Crypto has innovation, but it lacks stability. So instead of one replacement, what we're seeing is fragmentation. A slow diversification away from total dollar dependence, not a sudden exit. This matters because fragmentation changes demand at the margins. And in currency systems, margins matter. Even small shifts in global demand can influence borrowing costs, exchange rates, and long-term confidence. Now, let's talk about something even more important than foreign governments, the bond market. The US dollar is deeply tied to US Treasury bonds. These bonds are considered the safest assets in the world, not because the US is perfect, but because it has always paid its debts. Trust again. But here's the tension. As debt grows and interest rates stay higher, the US has to issue more bonds just to cover existing obligations. That means more supply. And supply needs demand. If demand weakens, yields rise. Higher yields mean higher costs. It's a feedback loop. So far, global investors have absorbed this supply, but cracks are forming. Major buyers like China and Japan are no longer increasing their holdings the way they used to. Domestic buyers, including banks and pension funds, are taking on more of the load. That works until it doesn't. Another quiet pressure point is demographics. The US population is aging. Older populations save differently, spend differently, and invest differently. Social programs grow more expensive. Productivity growth slows. This isn't a crisis tomorrow, but it is a structural headwind that compounds over time. At the same time, geopolitical risk is rising. The world is less stable than it was 20 years ago. Conflicts, trade wars, sanctions, and political uncertainty all add friction to the global system. Ironically, this has helped the dollar in the short term because in times of fear, people run to safety. But over the long term, overuse of financial power pushes others to look for alternatives. Now, let's address a fear that comes up constantly: hyperinflation. Hyperinflation is not just high inflation. It's a complete breakdown of fiscal and monetary credibility. It usually happens when governments print money to cover obligations without productive capacity to back it up, often after war or collapse. The US is not in that position today. It has real assets, real output, and real institutions. But inflation doesn't need to become hyperinflation to damage living standards. Persistent, moderate inflation is enough to quietly transfer wealth from savers to debtors. This is where psychology comes back into play. If people believe inflation will continue, they act differently. They spend faster. They invest differently. They demand higher wages. That behavior can keep inflation sticky even when initial shocks fade.